Welcome to this deep dive. When people talk about predicting the future of a business, or I guess the stock market, they usually picture a crystal ball.
Right, yeah.
But if you look at how real forecasting works, it's actually much more like reading a seismograph of the past. You're trying to decode the rhythm of what already happened so you aren't flying blind tomorrow.
Yeah, exactly. And I mean, that means understanding the physical shape of your historical data. You can't just throw raw numbers into a forecasting algorithm and expect magic.
No, definitely not.
The algorithm needs to know what kind of structural terrain it's dealing with to, make an accurate prediction.
So for you listening, whether you're trying to budget your department's sales for next year or attempting to time an investment, our mission today is to break down the 5 foundational patterns of time series analysis.
It is the critical first step.
And let's ground this. Imagine you're looking at a wildly fluctuating chart of retail sales. The absolute first thing you have to do is isolate the baseline.
Right, so we start by looking for a horizontal pattern. This is data that vibrates around a constant mean.
Okay, like what?
Think of weekly gasoline sales at a local station. It bounces up and down slightly based on who drove that week, but over a year, the average volume basically stays flat.
Ah, so it's the background noise of normal business.
Exactly. And it stays relatively flat until business conditions fundamentally change, like a major process improvement.
Right. And if that shift is gradual and spans multiple years, that brings us to the second pattern, right?
Yes, the trend pattern. This is a systematic movement to higher or lower values. They're driven by massive underlying forces.
Like shifting demographics or new tech.
Exactly. Evolving consumer habits. A classic example is a 10-year chart of bicycle sales consistently climbing as cities slowly build out more bike lanes.
Okay, so if a horizontal pattern is just the random ripples on a calm pond, a trend is the underlying tide slowly coming in.
That is a great analogy. Identifying that overall direction is completely vital for long-term planning.
But here's my issue with that. How do you know you're looking at a true trend and not just a really, really big ripple?
Well, that is the multi-million-dollar question in data science. You have to zoom out. A trend is sustained over years.
Oh, I see.
Yeah, if you only look at 3 months of data, a temporary ripple can easily trick you into thinking a massive tidal shift is happening.
Okay, but let's be real. Most businesses don't move in straight, flat lines or smooth slopes. They go up and down.
Which brings us to the repeating patterns.
Yeah.
The most common is seasonal. This is predictable clockwork.
Tied to the calendar.
Right. These are sequences of highs and lows that reliably repeat within a specifically defined short interval, like a calendar year or a quarter.
Umbrella sales are the textbook case here, right?
Oh, definitely. You see a massive spike every second quarter during the rainy season and a massive drop in quarter 4.
You can literally set your watch by it. But what about the economic waves that don't fit neatly into a calendar year?
You're talking about cyclical patterns. This is when your alternating data points fall above and below a trend line, but the cycle lasts for more than a year.
Okay.
These are tied to multi-year business cycles or long-term contracts, and they are notoriously difficult to forecast.
Wait, I need to challenge this because they sound exactly the same, just stretched out. Wait, so if seasonality is predictable, clockwork tied to a calendar year, cyclical patterns are more like unpredictable multi-year economic roller coasters.
Spot on. That is the vital distinction. Seasonality has a fixed duration. Q2 is 3 months long and happens every single year.
Right.
But a cyclical economic roller coaster.
Yeah.
You have absolutely no idea if an upcoming recession or boom will last 18 months or 5 years. It lacks that calendar fixed anchor entirely.
That makes perfect sense. It's the difference between a scheduled train and a wild animal. So what happens when you throw all of this into a blender?
Well,
You've got your underlying long-term tide, but you also have predictable seasonal clockwork riding on top of it.
that is our 5th state. Trend and seasonal. Think of quarterly television set sales. They predictably spike every single Q4 for the holidays.
That's your seasonality.
Right. But because the overall population is growing, the total volume of TVs sold is also steadily increasing year after year. That's your trend.
Okay, but how does an analyst actually calculate a forecast when the data is doing 2 entirely different things at once? Doesn't the algorithm get confused by the holiday spikes?
It does. Which is why data scientists use a technique called time series decomposition.
Hold on, decomposition. Are we like rotting the data?
Basically, you're literally stripping the time series apart into its distinct physical components.
Yeah.
You peel off the seasonal holiday spikes to isolate the raw, underlying long-term trend.
Wow.
Yeah, we use techniques like differencing to make the data what we call stationary.
Stationary, meaning we force it to look flat like that horizontal noise pattern we started with.
You got it. You mathematically flatten out the seasonal bumps and the upward slope. Once the data is stationary, you can feed it into advanced formulas, like ARIMA models.
Okay? And that calculates the pure probabilities of future movement before artificially adding the trend and seasons back in.
That is wild. You have to mathematically flatline the data just to see where it's actually going. So for everyone listening, before you can predict your future, you have to find the shape of your past.
Exactly. Horizontal noise, long-term trends, predictable seasons, unpredictable cycles, or a combination.
Right.
And keep in mind, all of these mathematical models fundamentally assume that the pattern of the past will continue.
But real data always contains random, unexplainable variations, which leaves you, the listener, with this to ponder. If you are analyzing your own numbers and suddenly see an unexpected violent drop, how do you decide if it's just a random glitch you should ignore or the very beginning of an entirely new cycle?